Okay, so here we go. Good evening, guys. It's Ken at Tortoise Capital. This is the Advanced Swing Trading Course weekend Q&A session for June 10th, 2018. Once I get this recorded and posted, this will become a live link for the replay. I'll get that uploaded at YouTube. So let's just jump right into the questions. Got quite a few to go through tonight. The first one was regarding the position sizing risk of 1R, comparing that to the execution stop risk, which is the price that disproves the hypothesis. And this is from Duke. So his study group from the Carey workshop are still having a debate over the significance of the E-stop. They've referenced this as number 7. That was number 7 on the I guess the blue belt test, maybe? Yeah, blue belt test. So how are they different? Okay. So a couple definitions first. The first one is that the P-stop is a position sizing stop that governs the size of the position. And I believe it should be plenty wide so that you don't risk taking a greater than 1R loss. I got to change that to R, sorry. And so this requires you to have two of these position sizing stops of reasonable profit available in order to take the trade. The execution stop, on the other hand, is the specific price in a particular price action that disproves the hypothesis of this specific trade. And I believe that this should be a fraction of your position sizing stop, preferably about 1/3 or less, so that this will accomplish several tasks. So first, let me draw a quick sketch so you can see where we're coming from on this one. Okay, so we've got a trade frame, and I'm going to use just something simple like a morning hook. And let's say that I want to use just a 1, 2, 3 entry. So this is going to be an intraday. And so my position stop on intraday, my recommendation is that your P stop should be a frog box until you refine it further. So 1 frog box. And that means, so if I propose to enter right here, and if my my frog box is that big, and let's call that 50 cents. So this is where it closed, and this is where it opened right here. So I have a little gap at play right here. From here down to here was a gap. So when I see that little price action right there, what I say is this. Well, in the first less than 10 minutes or less than 15 minutes, this thing had a small gap down, an orderly sell-off, then gave me a 1, 2, 3 possible entry. So the 1, 2, 3 entry is the first one that I feel justified in taking. The next one might be a P1. The next one might be the RLXD. The next one would be an owl. So there's like 5. Those are 4 price levels right there where I might take an entry. So when this thing comes down 1, 2, 3, and then starts moving up the price ladder, there is at least 4 particular price patterns that I might buy. And so since this is the low of the day, I might also take a hybrid frog box off the low. So call that an HF, which is, I'm defining that as 0.7 of a frog box. I might also just wait for a full frog box. Now, those are price distances off the low of the day. And so they're not always in the same relationship to those four price pattern entries, the 1, 2, 3, the P1, the RLXD, and the OWL. Based on the size of the hybrid frog, that could vary where they appear. But in any one of those 6 different price levels could cause me to want to get in. In every case, it was a violation of this little swing low down here at X. That's the price that tells me that the trade is invalidated. It's not until I actually see that price violate that this is no longer the swing low. Because my hypothesis here is that this low of the day, my hypothesis, H, what a horrible H that was. Yeah, my hypothesis is that this low of the day is going to hold as a swing low, and that the maximum reasonable intraday move is going to be a range stat, which we know is defined as, first of all, this full frog box off the bottom, a full frog box, plus an average range. So a frog box plus an average range gets me to this range stat price. All right. So depending on what pattern I'm using to get in, the amount of price that I have to pay of adverse price action to actually invalidate is going to tell me what my execution. That's going to be my execution. He was calling it an E stop. I kind of like that. Could also call it an X stop. But my execution stop is the stop that tells me I must get out here at X, because this price that failed says that hypothesis is no longer valid. Now, the point of the P stop is that no matter where I get in, I always have a constant R. My 1 R for intraday is a frog box. So the P stop is equal to a 1.0 frog box. I believe that my job is to try to get in as early as I can with enough probability of success that I can maximize my execution capture. And my execution capture is from wherever I entered to wherever I'm ultimately going to get out of this thing. That's what I capture in terms of price. And then the execution exit divided by a frog box is going to give me my whatever value of R I'm going to capture. Okay, so my XR. Now here's so if we understand all that, let me check with you guys, make sure we're all okay on that. Everybody clear on the definitions and the structure of that trade frame? Anybody not seeing that? I'm going to assume you see it unless I see something in the question. Okay. So here's why I split these stops into 2, and why this is different from the normal position sizing that you read about. First, when your normal loss size on this one, if your execution stop is like if you're getting in around a 1, 2, 3 or a P1 or the RLXD, normally that's going to be about a 0.3 R of a loss. And you may also decide that if I waited for the owl and this thing started to fail, I may not wait for this price here and get the collapsing dragon. I'm actually looking to get out somewhere in this triangle. And that would be a pocket entry, right? So if I let price climb all the way up through the owl, and then the owl doesn't work, but it starts to fail, I might be getting out when the RLXD occurs on this end. And that means I made a pocket entry on the short side, and now my loss is capped at 0.3 of an R. Well, when that happens, a 0.3 R is a low stress event to me, because in my mind, when I take a position, I've already psychologically accepted that I'm going to take a 1R loss on this one. So if I take a 1R loss, I'm not shocked by it. I just know that I took a 1R loss. And my job is to not take a greater than a 1R loss. So if I'm able to actually only lose minus 0.3, I actually feel like I made 0.7. And then I feel professional, and that gives me a positive boost that I made a professional exit, and that actually helps build up my discipline for doing the right thing, because I feel a 0.7 reward by having cut my loser short. So there's a psychological element. Second, it standardizes the position size for your instruments, since it's based off of a stable number such as 2 ATR for swing trades, or in our case, a frog box for day trades. And what do I mean by that? Well, if I'm trading Brazil, and I'm using 0.40 as my position sizing box, so that's actually less than a frog box, but I've become accustomed to 0.40. That means when I risk $400, I can buy 1,000 shares. So no matter where I enter Brazil, whether it's at the 1, 2, 3 entry, the P1, the RLXD, or the OWL, no matter where I enter that, I'm buying 1,000 shares. And my 1R loss is 40 cents a share. Now, if I get in at the 1, 2, 3 and it fails, I actually don't mind that, because maybe I only lose I may only lose 10 cents on that one. And so that's a 0.25 R. And then I'm going to stop and reverse. Now I'm short on a collapsing dragon. So my small loss when I was wrong doesn't blow me up. It's not a full 1R loss. And I'm short into a position that's already failing, and I feel good about that. So I actually get two pluses in my mind. If it gets to the P1 and then starts to fail, my job is to stop short and stop and reverse in the pocket. And again, I'm only going to take a 0.25 or a 0.3 loss. And then if it fails all the way through when it fails through the collapsing dragon, I can actually move my stop to no lose plus dinner for 2, and I'm already in the money, and it's probably paid for that loss that I just took. And so on. So what this means to me then is when I'm trading EWZ that day, regardless of what pattern I'm trading, a hybrid frog, an intraday Z3P, an owl, no matter what, I'm always trading 1,000 shares based on a risk box of 40 cents. And then my job is to try to reduce the amount of information that I need to invalidate the hypothesis for whatever I'm trading. And the smaller I make that loss, the more of the R I capture. And then when these things actually do make gains, it's scaled according to a 40-cent initial risk, and so the R multiples are also comparable as well. So this standardized position sizing based on the protective stop of the position sizing stop allows me to compare the results of the different kinds of entries for the instruments. It can let me compare the different strategies and their various entries, and it lets me compare between, let's say, EWZ and DIA, that an R capture of one may be fairly compared against an R capture of another one. Now, if you don't do that, if you say, well, I'm going to try a 1, 2, 3 entry, and I only need a 10-cent stop. Mathematically, if you wanted to risk $400, you would be allowed to buy 4,000 shares. So instead of trading 1,000 shares, I would have 4 times the position size on an entry that I expect to fail more often than another. And then if I get any kind of slippage, now suddenly I've lost a larger than 1R move. That's a horrible position psychologically and biologically to be in. So I don't think that's psychologically very sound for me. And because I want to trade a lot, I want to trade 40 times a day, intraday, when I'm day trading. And that means that if I can reduce the emotional and cognitive complexity and the biological stress of every decision, that it's a lot easier for me to maintain that level of activity without losing my mind. And it also means that I don't have to be on my A game every day to make money, otherwise I blow up. No, I can be a C- trader and still make a reasonable living. Now, what does that mean? It means that I'm not hitting home runs with a maximum position size on every trade, but so what? I'm not trying to hit home runs. I'm trying to make contact, and I'm trying to trade a lot because I have a positive expectancy system, and I want to achieve the expectancy. I'm not looking for each and every one of these things to be the maximum possible reasonable trade. Far from it. I think that's a way that you can just get burned out, and then you start chasing your own tail, and then I lose all my discipline if I do that. So I don't think that's a good idea. Now, that's what I mean by this paragraph. In standard position sizing, when you make the E stop and the P stop the same price, you can get a very wide variation in the allowable position sizing, which adds stress. And I think people do that either because they don't realize it, or they're trying to get the maximum position size because they actually believe each and every trade they pick is going to be the one that wins. That they think because they picked it, it has a higher probability of success. I think that's crazy. For me, it's crazy. It may be different for you. The final thing I want you to notice is that if your E stop is about 1/3 the size of your P stop, so if here's the P stop, and then you have, you know, your execution stop is here, and your P stop is there, and you require 2 full P stops of reasonable reward. And by the way, intraday we get that because the frog box, you get one of those. There's normally 4 frog boxes a day available. That's and if you give up one, then there's still 3 left. So it's not hard to find moves of 3 frog boxes a day. And so if my execution stop is really just 1/3 of that, yeah, in reality, I have the potential for 6 execution gains. So you say, well, Ken, isn't that really the same? Why don't you just use the execution stop as your position sizing stop and then demand a 6R win? Well, because the execution stop varies so much based on the way the price actually unfolded. If I saw something like this, I may not want to take a 1, 2, 3 exit because it's so huge. I might want to just take a hybrid. The hybrid frog might come in sooner than a 1, 2, 3. And then I'd have to compute what my position size is for this versus that. And I don't want to fiddle around with that in the middle of trading. I want to know that every day I'm trading 1,000 shares of EWZ for 1 unit of risk. That's all. And then my job is to try to get a micro improvement. So if I can exit at the 1, 2, 3 instead of the P1, or enter at the 1, 2, 3 other P1, or if I can enter at the RLXD instead of the OWL, I might save 15 cents, and that's going to equal to about a plus 0.3R improvement instead of waiting for the owl. And I don't mind trying to play for that minor increment. But I don't want to triple my position size just because I'm trying to get a slightly earlier entry. Boy, that would just place so much stress on you inside the moment if you're trying to trade more than one instrument, or you're trying to do a span of control of 2 or 3 or 4. I mean, forget about it. I recommend to you, use the frog box, figure out how many shares you're going to trade that day, no matter what pattern intraday, and then trade that. And then you can compare, hey, how did I do on the Z3Ps, or the sideways quiet channels, or the continuation pattern, or the whatever it may be. And 1R means 1R, no matter what pattern that you happen to be trading, or which particular entry you take inside of that system, or which particular exit you take. It all gets standardized against the R ladder of that day. It may take a little while to get your head wrapped around that, but I'll tell you what, that has stabilized my psychology so much. It's just like going to the poker table, and a $25 chip is a $25 chip, and then you just decide which hands you're going to play, or which game you're going to play with $25 chips. So it normalizes all of the risk, and then lets you compare the performance between different entries and different strategies and different patterns. Okay? That's everything I propose to say about that. Oh, the question continues. Sorry. Let me scroll down here a little bit. Okay. Part B of that question. Aside from having a trading system that protects from having more than a 1R loss, and by the way, don't say that as if that is a non-trivial thing. That's a really important psychological moment, by the way. You know, not only do I trade the same number of shares in Brazil every day, I do that every week or every month. So that when I do my longer term roll-ups and I get 30 or 40 trades and I'm doing a comparison, they're all being taken with the same position sizing each and every time. The amount of stress that I had on any one of those trades is all the same. So once I get the position size for a month, I tend to just leave it alone. And I don't take more than 1R losses. And it makes the math a lot easier to tolerate. So, aside from having a trading system that protects from having a more than 1R loss, is it purely psychological? Yeah, I wouldn't. You almost said only psychological. Yeah, it's psychological. That's 90% of everything. But it's also mathematical in the sense that it reduces the cognitive complexity of determining the trade sides on each and every trade. And that, by the way, cognitive complexity is what scales up your stress. And the emotional stress of having a really wildly variable position sizing. Okay, so the same thing applies like in swing trades. I gave you the day trade example, but the same thing applies. Execution stop versus. And so now on that one, let's say you had a 5-day down, since after all this is a swing trade course. So we have the 5-day down, and then we frame that, right? And our entry is here, and our exit is there, and the 10-day high is up here. And then on the basis of this, we say, when you see me computed on the daily report, the auto framer and such, I take this risk and compare it to the 10-day high. And then I give you the reward to risk that way. But for positions, and that way you can compare the size of the, because these are mechanical placements. just using the range risk. But when it comes time to actually taking this position, I recommend that for that may be an ATR right there, and 2 ATR, something like that. That's the one that I recommend using for position sizing risk. And then what I look, and I will tell you, on any given swing trade, a 4 ATR is not unreasonable. If you take a look at a lot of symbols, using raincoat charts to count how long the trends are, finding a string of 4 after your entry is not unusual. So I don't worry about that so much. In terms of execution risk, I'm just looking to normalize. I do 10-day high and the range risk in order to compute the reward to risk ratios to be favorable. Okay? All right. Part C. I discussed having 4 bullets, each bullet being worth $400 of risk. Could I elaborate more on the benefits of that by giving an example of how the E-stop and P-stop would apply to this? Well, that's really a compound question. The first one is the idea that I use a standard unit of risk, $400. That's my chip. That's 1 unit of risk. That's the number of dollars right now that 1R equates to. Now, if I want to get bigger position sizing, here's what I do. Instead of changing any of the trade geometry about what's 1R versus 2R execution, I never change that structure. What I do is I change this number. The next step for me is to go to $500 of risk. And that way, I don't have to change a single thing about my geometry. I don't have to go from, instead of 2 ATR to 1.5 ATR for position sizing. No, I just change the number, the dollars at risk per trade. And that should be some percentage of your portfolio. And then whatever that percentage is, the total number of open positions equals your portfolio heat. So that's the number that you vary in order to get larger. What you don't want to do is build up a lot of expertise using this kind of trade geometry, and then when you want to get bigger, suddenly change it, say, hey, my position sizing stop's going to be 1 ATR instead of 2 ATR. Well, you don't have any data that says that that's a good idea or that's manageable or that you can handle that stress, and yet you're going to increase your position size on the basis of zero evidence that you can do it. I don't think that's a good idea. All you got to do is change the quantity of dollars at risk. Now, the idea of 4 bullets for me is not really related to the execution and position size stop at all, except to say that this is really a daily R, as in 4 chunks. And then what that means is I can only have 4 positions on. If I take one and then add a second one and a third position, then I double up on the first one, I've used my 4 units of risk, and now I don't have any capital available to take another trade until I liquidate some of these trades in order to raise money. And then what I like to do is I like to cash 2R, and then I can take any extra and then start redeploying. So if I ever get all my money in, I want to take 2R out, set it aside, then cash some more in order to raise a new bullet, a new R. Okay. So what that does is this acts as a governor on my emotions, a regulator. And so what I like to do is get the first position in on something, first position in on something else. So maybe this is EWZ, and maybe this is DIA. And then I still have 2 bullets over here. And then maybe EWZ is really working well, so I put a second scoop on that one. Now I'm down to 1 bullet available, and I have 3 bullets deployed. Now this is when I say, hey, Brazil is fine, so I'm going to scratch that, and maybe I made 2R on that one. So now I actually have I have the one that I hadn't spent yet, and I have one bullet over here in DIA, and I made 2, and I got my 2 original bullets back that I used to put on. So now I actually have 5 over here. If I'm in that position, I like to take the 2 that I earned and just put those in the bank for tomorrow, and now I'm back to having 3 bullets available plus 1 committed. So what you can see is that this acts as a regulating function for asset allocation, and this is what we call span of control, and that's how many simultaneous positions can I manage in a professional manner without being sloppy and without causing myself emotional grief. And for me, that number is 4. And so that's why I break the daily capital up into the 4 bullets. Okay. So this is a way to reduce my stress and to keep me from going off the deep end. So this is a purely psychological element. Now, the deep-seated psychology of this is that there was a time in my early life when my dad would hand me 4 bullets for a 22 long rifle and say, go out and bring home 2 rabbits, because we're going to eat them and we're going to sell the fur so that we can buy more ammo. And so when you only have 4 bullets and you're trying to bring home 2 rabbits, you're very careful about the shots you take. If it's not a perfect shot, you don't take it. You just keep looking. Right? Don't waste ammo. And then, based on my military experience, those 4 bullets are like my soldiers, and I wouldn't put my soldier's life at risk on a trivial gamble. I would do it on the basis of a reward to risk ratio. And so those 2 emotional connections for me help me regulate my own emotional behavior when it comes to managing my 0 state. So that's the idea of the 4 bullets. Okay. Okay, moving on. Okay, next one, question 2. In regards to 0 state, and then this notion of time, will, pattern, and money. I thought this was a very nice paragraph Duke wrote. Throughout the day or days, depending on our time frame for the trade, we encounter many decisions. Whether to take a trade, cut the trade to take profits now, hold for a potential larger gain, cut losses, etc. That add, each one of those adds to our daily routine decision count. Depending on the count of the number of decisions you had to make, it may go over your threshold, which eventually deteriorates our decision-making process due to decision fatigue. Yes, that's like the cognitive cost of making decisions. So this can definitely hinder our trading results. This could affect our will to trade and our proficiency, and also how fast we can refresh our 0 state. So the 2R battle drill directly deals with this issue. Is there anything else we can do to improve the 0 state and the will to trade refresh rates? Yeah, so first, good point. The 2R battle drill reduces the cognitive complexity down to simple pattern recognition and execution. So almost no emotional cost of doing that. But what else can we do? Generally speaking, I think it falls into 2 categories. First, you can make re-entering the 0 state very easy by having a simple procedure and then having practiced it the same way each and every time. So that if you watch guys shooting foul shots on the basketball game, they get to the line and they go through a ritual and they visualize and they shoot it exactly the same way every time. And they practice that at practice to go through exactly the same steps. So that's the first thing you can do. For me, it can be drums. Make re-entering the zero state simple, repetitive, satisfying. Second thing. The second thing you do is generate positive feelings from professional behavior by acknowledging your professionalism and enjoying the boost of positive energy which comes from doing that, and it recharges your will to trade well because you feel good about being professional. And I talked about that before, about saying I have convinced myself that when I make the trade, I'm already down at 1R, but if I can improve that exit and only take a 0.3R loss, I actually made a 0.7 win. So, and that's the size of my average win intraday. So that I just made an average win. So I actually feel very good about cutting a loss short. So those two things right there, you can make the mechanical activity easier, and you can reward yourself and find ways to generate emotional energy. And then it becomes like anything, it's conditioning. Okay. Question 3. So now we're shifting to Jake's set of questions. Duke, you guys should get a hold of Jake and add him to your study group. He's a professional golfer, and he is really doing some excellent work on his own. I think would benefit from being in a group, and you guys would really benefit from his perspective. He sort of independently worked out an explanation of what the frog box and the range stat really are and why it matters before he even saw the material, just on the basis of listening to a couple of videos. So that he's pretty sharp. And if he hears that, that'll probably embarrass him. So good. So he asked, why did I start with the RL10 in the first place? Why a factor of 3? Is it simply that these 4 RLs are the most commonly used in the industry on any time period? Well, first things first. I started with 10 because I use the 10 period look back a lot in every time frame, and it's a round number. Right, so the 10 period NDX and the 10-day high, 10-month standard holding periods. That's a 200-day moving average, by the way. The 10 period was just a natural place to start. The factor of 3 is kind of a standard variable between slow and fast. And it's also connected to me desiring to capture the middle third of any trend. So if the full trend was from here to there, and I can divide that into 3, I'm just trying to capture the middle of this. I think that first segment, I'm trying to get my exit or my entry, and that last segment, I'm trying to fine-tune my exit. And so I may not be very good in those areas, but if I can capture that middle third, well, that's 1/3. So I look at that scale of 3 to 1, and so when I use 10 as the fast, using 30 as the slow felt natural, and when I tried it, it made sense because it resonated with my mind states, and it seems to have utility in all different time frames. So there's some. Now I've also read some other things from some systems developers that I really respect, and they say that ratio, any ratio between 2 to 1 and 6 to 1 between fast and slow is reasonable, and so using 3 or 4 puts you right in the middle of that sweet spot. I just prefer 3 because I started that way and I like it. Now, on the other hand, I would say I don't know of anybody else that uses regression lines the way we're using it. So I would say that's not an industry standard. And oh, by the way, that's potentially an edge. If we learn how to master that symbol and act, we have a unique way of looking at the market that is therefore robust because it's not well known and therefore not gamed. So it's the opposite of an industry standard in that sense. The next question from Jake had to do with deciding which time frame to pick. Again, I would say no one uses regression lines the way that I do, and I'm not actively investigating to see if anybody else is because I don't care. and it works for me, and that's good enough. Now, what I would say is that there do seem to be standard time periods that people pay attention to, such as these minute charts, anywhere from 1, 5, 10, 30, or 60, and then daily, weekly, monthly, based on the style of trading they've adopted. So I would consider those to be standard industry standards. However, there's other things like tick charts in odd times, and multiples of ATR that different people with algorithms and technical savvy are using. But by and large, I think you'd find those are the standard time charts. And I think the way we've organized this into sort of like position trading, that long term once a month, swing trading, 2 to 10 days. So that's monthly, and probably weekly. Then 2 to 10 days, and then anything from like 30 minutes down to 1 minute would be the intraday or the daily trade. And then core and turbo lives on the boundaries between those two. So when position is the core, then the swing is the turbo. And when swing is the core, intraday or daily is the turbo. And so the time periods for the charts that you pick are simply adjusted accordingly. Now, the important part of our frames of reference and our patterns is that they're all fractal, and that a P1 or a Z3P or Frogbox, all of those things are the same regardless of the time frame that you're looking at. So I think you have to find the one that suits your own time schedule. How much time do you want to put into monitoring the market? How much lead or lag time do you want to take? The longer between intervals, the wider your stop's got to be, obviously. But yeah, that's how you sort through that. Slope stat. This was a technical one. Is it the value of the RL30? You plot a value for the degree of the slope? Not quite. So the way the regression line works is this. So you have some mix of data. So the regression line, the 30-period regression line, is the straight line that is the best fit. So it minimizes the error between how far, and the error is how far each of these points are from that line. So the regression line is the line that has the least error when you plot it for those 30. And then the final on day or time period 0. So this is time period 0, and it goes back 29 for a 30-period regression line. You're using a total of 30 time intervals, including the one that you're in. So the way this is computed in real time then is wherever that price is right now, that's your 30th price or your first price, and then plus these other 29 that are already marked. And then it draws the regression line and then plots where, so if I were to blow this up here, right, and zoom in, the regression line is drawn, and then it predicts this is where the price should be in order to have 0 error. And then the actual price may be up here or down here, so you have some amount of error. But it's this location in the 0 time window, in the 0 look back, which is where that RL30 is drawn. And if it was RL10, it would just be the 10-period regression line. So now the least squares moving average is not a straight line, but what it is it was the price that was plotted as the perfect point, and then a new bar opened, so that thing gets marked in the book, and then the next one is plotted here, and the next one is here, and then here, and then here, and here, and so on. And so you get this wavy looking curve, and that's what that moving linear regression line is the line that connects. It's the curve that connects all of those computed points that get updated every time frame. every time period. Okay. Now, that's what that moving linear average is. Now, the slope stat is something that's a little bit different. So the slope stat says that for those 30, we'll take this one, for that 30 bars, this line is drawn, and then if we compare that to a perfectly flat or a zero slope, this angle here, that degree of slope tells you how good that trend is. If that thing had been perfectly sideways for 30 periods, the slope is zero. It's going nowhere. The steeper up it goes, the better the trend. So what I do is I look back to compute the slope stat. We look back 180 days or time periods, and we draw all of these slopes, and we record the slope value of each of those rolling 30 period slope lines. And then we find, for those 180, we find the max, the min, the average, and the SD, which is a box. Right? And then we take the average plus 1 and the average minus 1. And I call that, this average plus or minus 1, that's the normal. And if that slope is steeper and it's up in here, then this is a very good upward move. And so this is and we put a z-score on. This is 1.00 minus 1z, and then all the way up this z-scale ladder. And what you get is a bell curve on its side, sort of like this, that says 2/3 of the time the slope was inside this value. So if you get a slope stat better than 1, it tells you it's already an abnormally strong slope. And that's an adaptive measure of how good it's ever been and how bad has it ever been, and then where is today inside that series. And so the questions were being asked and using this chart from the daily. Yeah, so the dotted line, the dotted red line, this dotted red line here is the zero line. So anytime the blue line is the slope, and then the black line is a 10-period moving average of slope, its own 10-period moving average. And that just acts as a smoothing function, like a noise barrier. And what you notice is when this thing gets to an extreme and then crosses its own 10, that's a sign that it's going the other way. And then this becomes a signal of a potential swing low or swing high. Now, if the dotted line is the zero line, the black line is the current 6-month or 180-day average, the average of 180. And then the green lines, that's +1 standard deviation, +2, this is -1 and -2. Now what I want you to notice is when this thing rolls over, and by the way, the same logic works down here. Oh, it's the same chart. So when this thing rolls over and it's coming down, even though this is declining, the slope of that is still favorable. It's just not as steep. It's like if price did this, and the first slope of the 30 was like this, and then as you keep adding a day, it gets to the point where it was really immense, and then starts rolling down. As long as it's above the zero line, that slope is still favorable. It's not till it crosses the zero line here. This is where it got negative, and this is where it got positive again because it crossed it to the upside. So what you get is a very smooth and orderly sine wave of how strong the slope, how strong the trend is. And that this again is a not an industry standard. This is just one that we use, and I have found it to be immensely valuable. Look how sweet these curves are and how long. It's almost like the MACD histogram and the risk Z. You have a very clear-cut point. So the thing to watch for is anytime you get a crossover and it reverses and it's more than one standard deviation outside of normal, those become significant turning points. Okay, so that's everything I think you need to know about the slope stat for right now. Okay. Next, had some questions about the RLCO framework. Yeah, is everything inside the river considered to be noise and not significant? Yes. The river is noise because that's average plus or minus 1. And also, but you can't have P1s inside the river because a P1 is defined as an RLCO outside the river. So you can only have them outside. Now, they'll get crossovers inside the river, but it's not a P1. A P1 has a precise meaning in the way that we use that. Next, is the RL10 crossing the dragon significant because the RL10 is faster than the 10 SMA? Yes. So if you just look at a chart, you'll see the 10-period moving regression line like this, and then you'll see the dragon do something like this, and the dragon is that 10-period Bollinger Band plus or minus a half, and in the middle of it, the middle of that Bollinger Band is a simple 10-period moving average, and will eventually do this. So the difference between the SMA and the least squares moving average, the moving regression line, is that. That's how much more adaptive the regression line is. And then when it crosses over, this is the fast RL crossing the slower SMA, and that's, and now I treat this as a noise boundary, the width of the dragon. So if this thing gives us a P1, so usually the 30 is like right about here, and it changes out around this way. So you get the maybe a 1, 2, 3 down, a 1, 2, 3 up. You have a P1, you have it entering the dragon, leaving the dragon, and somewhere out in here you'll see an owl occur when the dragon rolls up and then 30 begins to roll up. So that's sort of the life cycle. Yeah, so the idea is that the difference between the RL and the dragon is the difference between a 10-period moving regression and a 10-period simple. You'll see the same thing on the river. So the river is this thing right here. The middle of that river is a 30 SMA, and then you'll see the 30-period regression line do this. And so here are the checkpoints. When the 30-period regression line starts to roll up, now you're in owl territory. And then what? I like to watch when it enters the river, crosses the Bollinger Band mean, and leaves the river. What I've noticed is that when the 30 crosses the 30, it's up. The old trend is over. And now this one, when it leaves the river, remember by this time price has already left the river and the RL10 has left the river. Now when the RL30 leaves the river, that by definition, by our definition, is the beginning of trending behavior. So I think there's some very good questions and insights in here that that Jake is clued in on, that he detected that relationship, and he's asking me a confirming question. So I think that's very well done. And he says, well, why do I consider the dragon a noise boundary? Because once the RL10 has moved that far and crossed its own 10 and emerged from the dragon, I find that this is more likely to be a move that continues. It's moved far enough that it has some validity. That's all. It's an intuition. And then what's the baby dragon? So the baby dragon was, I like to get something that was in here even sooner, so I put a 4-period Bollinger Band of 0.25. and it acts like the baby. It's a baby dragon. It's much narrower than the mama dragon. And now we have the RL10 turns. It crosses the baby dragon, crosses the mama dragon, and off we go. And then what we found is that on the weekly charts, that when it makes the turn and it crosses the baby dragon, on a weekly chart, that's good enough. You can actually front run from there instead of waiting for a full dragon. That might be the difference of 2 full weeks in a swing trade that's already starting to work. So that's where the baby dragon comes from. It was an attempt to calibrate and mathematize these different decision points along the price ladder. Okay, so that's all the questions. There were just a couple things I wanted to hit. We're coming up on an hour, so I just wanted to go through a few things that I thought were noteworthy this week. If I can find them. Yeah, why did I pick this one here? Okay, so this was a gap up. Yeah, somebody traded this one really nice. Yeah, so this was a gap up. This was a frog box move off the bottom. Bought it. This one looked like a pocket. Second one, and then this was the exit. Amazing. Very, very clear. So this was the hybrid frog, and this was a trade pattern that works. Okay. Just want you to know this exit point. If we get in the habit of coming down here to see how they. Now I recommend you put the Bollinger Bands on this one. This is Jeremy's. This is where, when that crosses the 0 line, this is where it's now a negative bias, and it's down. When it crosses the 0 line here, that's where you can pick up the long bias. So yeah, so that was a hybrid frog, and be ready to trade it. So this is the 7-hour trade in Brazil. I mean, Brazil has just been so good. I mean, it's been getting smoked on the swing trade and the weekend report. It just continues to be horrible. So this is one where we traded it in a number of ways. It was a sell-off and a morning hook. This was actually a gap up, and then it sold off, morning hook, and bought it and started to stall, sold it. This was Duke's trade on this one. He actually had he got it as an RLXD entry right there, and then cashed it right here at that crossover, right? So this box equates to this box. And so Duke's point on this trade was, from the chat room, hey, maybe I left some on the table by waiting to cut it off at the RLXD, but he likes to stick with the exit rule. And then I said, right at that moment, up in that blue dot, EWZ is now postured to test, and it'll either go up to close a gap. That was right. This was a gap down. Sorry. It'll either go up to close the gap, or if this thing fails to close the gap, it'll roll over, and then we're going to be postured for a pocket trade short or a collapsing dragon. And this is my favorite morning play. Well, about 4 bars later, Duke's exit was basically the high. It did not go on up to close the gap. It rolled over, and there's my pocket entry. And here is my collapsing dragon second entry. Confirmed when this one happened, and down it goes. On this little rebound, I cashed. And then from the swing low, I just drew that line over and said, well, if this thing doesn't go that way, then there's a good chance it fails. and there was not enough of a pocket to buy, so I got the collapsing dragon right here, and then it came down and made this little bump. Nothing. Collapsing dragon for a second entry. Felt like a nice capture. 1, 2, 3. Crunch. And then as soon as I do that, I set up the collapsing dragon again. Got the last one. Now for the rest of the day, okay, so that's 7R right there collectively. And then the rest of the day it did this. So this was actually somewhere right around in here. There was a 1, 2, 3 kind of emerging dragon pattern, an ED, which gets you into this long move. So that was the 7R trade in Brazil. Next one, look at. Okay, so that was Duke's. Beautiful trade. What did it? An owl, or yeah, that's an owl entry. This would have been a 1, 2, 3 down here, and then waits for the RLXT. Nothing wrong with that exit. You could do a 1, 2, 3 and get out a little bit earlier, but still, that's fine. Nothing wrong with that one. This is from Bob. Just a beauty. Oh. So he's using the VWAP. He had set this one up with a favorable. It'd been one of those long, and then started to hook up, and then it gave him this. This was the Pacific Open. It went up into here, so he ended up buying here with a stop below the VWAP. I mean, how good is that? Just too sweet. That nice long low grind and the power of the VWAP. The last one I wanted to show was, I've been doing some work on the let's see, erase drawings. So I'm doing some work in Excel. That's what, comparing the simple moving average and the least squares moving average down in the MACD histogram. So, so what I'm really looking at was when you do the MACD histogram on TC2000, you can pick what kind of moving average you want. A simple, experiential, front-weighted. You can't pick the regression, the moving regression line. So I said, well, let me design that in Excel and see if that's something that I want to do. Because if you have a 1030 MACD histogram, then a P1 down here will also give you the P1s up there because it's tracking the regression lines. It turns out that when you look at the this one on top is the, if I compute the MACD histogram with least squares, it turns out that you shouldn't be getting signals inside here because everything is so tightly compressed in the river. But the least squares are so adaptive that you get this very significant waveform. It's almost too precise, and it makes you think there's signals that aren't really there. Whereas the simple moving average gets you in plenty soon here and here, and then gets you out plenty soon. So it just turns out that when you're constructing the moving average convergence divergence, that it's okay to use the simple moving average for that. That actually acts as a bit of a filter, and what it really means is when it moves below the zero line and then hooks up, then you're going to be in good shape. And it turns out that what you're actually seeing on this MACD histogram is not the relationships between the RLs, but you're actually seeing the relationship between the dragon and the river. And I had that little moment of zen this week where it finally just clicked into my head that that's what was going on. So this is really kind of cool. So you have, at some point, you have the river with the that 30 period simple moving average in the middle, that red line, and then you have some kind of move down here with price, and then the dragon follows it. Well, the dragon is the 10. And so when you compare the gap between the 30 and the 10, that's actually the gap that the MACD histogram is checking. And when the dragon crosses the river, you now have an upward bias. He's crossed to the north side of the river. You should have an upward bias until such time as he crosses and goes below the center line. That's really a good idea. And with the MACD histogram, the way we've constructed it then, is geared to really illustrate the relationship between the dragon and the river. So that was my moment of Zen this week. Okay, so pending any other questions from you guys, that's everything I wanted to cover this weekend. There was a really good video posted on the Adapt Trade Builder study that that Jeff and Bill Scheidt put together. And among other things, what it confirmed was the idea of the, on multiple time frames, a 2 ATR initial stop works on 4X on 3-minute charts the same way that it works on weekly charts and equities and daily charts and equities. It's really a pretty good idea. There's something fundamentally connected to who we are as traders with that 2 ATR on any time frame. It seems to be fractal in nature. And they were using a 4 ATR profit target, so that 2 to 1, and that was giving them a system quality number better than 3. So those slides are posted in the chat room, and the video explanation is on the YouTube channel. So I leave that to you to follow up with. Okay. So if there's no other questions, then I think we're good to go. And I'm going to go ahead and stop her right here and wish you guys a good rest of the weekend.